Yo, what's up, everyone? This is episode 3 of Macro from Zero for Forex. Uh, so, if you didn't watch the episode 1 and 2, I highly suggest to do that first because some stuff may be relevant to that. Probably like all of the stuff, and you might not understand everything. So, without more stuff, let's just jump straight through it. So, let's start with opening. So episode 1 was interest rates, the engine that adjusts currency values. Episode 2, inflation, the fuel that makes central banks move those rates. Today we cover the other half of the equation. The Federal Reserve has two jobs. One, keep inflation at 2%. Two, maintain maximum employment. We call this the dual mandate. Episode 2 covered mandate number 1. This episode covers mandate number 2. And here's the thing, these two mandates are often in conflict. A very strong labor market usually means wages are rising, which means people are spending more, which means inflation stays hot. So the Fed often has to choose between fighting inflation and protecting jobs. That tension between jobs and inflation is one of the most important drivers of central bank policy, and therefore currencies. So let's get straight into it. Why the labor market matters. The labor market matters. The labor market tells us one thing about everything else. Is the economy running hot or cooling down? When unemployment is low and jobs are plentiful, people have more money to spend. More spending drives up demand. Higher demand drives up prices. In other words, a very tight labor market is inflationary. And as we learned in episode 2, inflation forces central banks to raise rates. Higher rates strengthen the currency. When unemployment is rising and jobs are being lost, the opposite is true. People spend less, demand falls, prices stop rising. The central bank cuts rates to stimulate a falling rate environment, weakens the currency. This is why every major jobs report is a market moving event. Not because employment data is interesting on its own, but because it directly tells you what the central bank will likely do next with interest rates. The Fed has a rough target for this. While the 2% inflation target is explicit, the maximum employment mandate is more flexible. The Fed typically considers around 4 to 4.5% unemployment as consistent with a healthy, non-inflationary economy. Above that, they start thinking about cuts. Below that, especially if wages are rising, they worry about overheating. Strong labor market, inflationary pressure, rates higher, currency stronger. Weak labor market equals disinflationary signal equals rates lower equals currency weaker. That's the framework. Everything else in this episode is detailed around those two sentences. So the key indicators. The labor market isn't one number. There are 6 key indicators, each telling you something slightly different. NFP, non-farm payrolls, the headline number, every month, the holy shit, I can of labor statistics count how many jobs were added or lost across all non-agricultural sectors. When you hear the jobs report came in hot, they mean NFP was above expectations. The single most market moving monthly release after FOMC decisions, released the first Friday of every month, 8:30 a.m. Eastern Time. The unemployment rate, released at the same time as NFP, the percentage of the labor force actively seeking work but unable to find it. Below 4% is considered tight. Above 5% starts to look recessionary. Labor force holy shit, I can't even read today. Participation rate, the percentage of working age adults who are either employed or actively looking for work. Crucial context for the unemployment rate. If unemployment falls because people gave up looking and left the labor force, that's not healthy. The participation rate tells you the real story. Average hourly earnings, the wage data, the direct connection to inflation. If wages are rising at 4, 5, 6% annually, workers are spending more, which drives up prices. The Fed watches year-over-year wage growth carefully. Anything above 3.5 to 4% makes them nervous. Initial jobless claims. released every Thursday at 8:30 a.m. Eastern Time. How many people filed new unemployment claims that week? The most real-time labor market indicator we have. A sudden spike in claims is an early warning of deterioration, weeks before it shows up in NFP. JOLTS, Job Openings and Labor Turnover survey released mid-month shows how many vacancies exist. In 2021-2022, JOLTS hit 12 million open in positions, nearly 2 jobs for every unemployed person. That's the kind of overheated market that makes the Fed panic. Why it moves currencies. Strong jobs data above consensus, more people working means more spending, more wages, more wage pressure, more inflation risk. The market prices in more rate hikes. The currency strengthens. A hot NFP number can move a major by 80 to 150 pips in the first 60 seconds. Weak jobs data below consensus. Fewer jobs means less spending, less wages, less wage pressure, less inflation. The market prices in rate cuts. The currency weakens. An NFP miss can wipe out days of gains on a pair. But here's the nuance. The concept called good news is bad news. In a hiking environment like the US in 2022 and 2023, a very strong NFP report was bad for stocks. More jobs meant the Fed had to keep hiking, which was expensive for companies and consumers. But it was good for the dollar. Higher rates make USD more attractive. This trips up beginners constantly. When the economy is strong and the Fed is tightening, bad economic news like weak NFP can rally stocks because it means the Fed might pause, but it weakens the dollar. Good economic news, hot NFP, weakens stocks but strengthens the dollar. The currency impact is cleaner than the equity impact. Strong labor market plus hiking Fed equals dollar stronger. Weak labor market plus dovish Fed equals dollar weaker. Keep it that simple for now. As you get more experience, you'll learn to read the nuances, but that framework will keep you on the right side of the majority of moves. The NFP deep dive. NFP comes out first Friday of every month at 8:30 a.m. Eastern Time. It drops 3 numbers simultaneously. The current month's job additions, the consensus estimate Wall Street was expecting, and the previous month's revised figure. That last one is important. The previous month is almost always revised, sometimes significantly. A month that initially came in at 150,000 jobs might get revised to 100,000 the following month, or up to 200,000. Those revisions move markets even when the current month meet expectations. The 3-number read. 1. Current month versus consensus. This drives the immediate reaction. Hot versus expectations equals dollar up. Soft versus expectations equals dollar down. 2. Wage data. Average hourly earnings. Even if NFP is in line, a surprise on wages can extend the move. Hot wages alongside hot jobs is the most dollar bullish combination you can get in a single release. 3. The previous month revision. A big downward revision to last month can completely offset a good current number. A report with 200k new jobs and previous month revised down by 80k is actually a 120k effective print. Always check all 3. Trading NFP, same process as CPI. Know the consensus before the release. Prepare both outcomes in advance. Do not pre-position, wait for the initial spike to settle, at least 60 seconds, ideally 3 to 5 minutes. Then trade a sustained narrative, not the first candle. One added note, NFP produces false breaks more often than CPI because jobs data is inherently noisy and gets revised heavily. Be especially patient before entering. The first move is often the wrong one. So, wages, the inflation connection. The wage data inside the NFP report is arguably as important as the headline jobs number. Here's why. When workers have pricing power, When unemployment is low and companies compete for talent, wages rise. When wages rise, workers have more money to spend. More spending drives demand. Higher demand drives prices. Higher prices are inflation. This is the wage price spiral, and it's why the Fed cares so deeply about labor market tightness. In 2021 and 2022, average hourly earnings were growing at 5 to 6% year over year. That's well above the roughly 3.3 to 3.5% the Fed considers consistent with 2% inflation. As long as wages were growing that fast, inflation wasn't going away, regardless of what happened to energy prices. The Fed knew it. That's one of the reasons they kept hiking even as headline CPI started to fall in late 2022. The specific number to watch: average hourly earnings year over year. Above 4%, labor market is adding inflationary pressure, a hawkish signal. Around 3 to 3.5%, cooling but not alarming, neutral. Below 3%, labor market is generally easing, dovish signal, cuts possible. The other indicator, the employment cost index, released quarterly, a broader measure of labor costs, including benefits. The Fed actually watches this very carefully, even though it gets far less media attention than NFP. It's released at the end of January, April, July, and October. Check it before every quarterly FOMC meeting. The bottom line: wages are the missing link between the labor market and inflation. Strong NFP with strong wages is the most hawkish combination. Soft wages can offset an otherwise strong soft wages can offset an otherwise strong jobs number. Sorry about that. The labor market toolkit. Here is every indicator, every release, every timing you need to track the labor market as a Forex trader. ADP private payrolls, released the Wednesdays before NFP. 8:15 a.m. Eastern Time, measures private sector job additions. Think of it as a preview of Friday's NFP. It's not always accurate. Sometimes it contradicts NFP significantly, but it moves markets in the 48 hours before the big number, and it sets the narrative going into the release. Initial jobless claims, released every Thursday at 8:30 a.m. Eastern Time. How many people filed new unemployment claims that week? The most real-time labor market indicator available. Watch the 4-week moving average, not just a weekly number. A trend of rising claims, even if gradual, is an early warning sign of labor market deterioration, often appearing 4 to 8 weeks before it shows up in the headline NFP. NFP plus unemployment rate plus average hourly earnings, released together on the first Friday of every month at 8:30 a.m. Eastern Time. Your highest impact labor market event. Block out the whole morning. Read all 3 numbers before reacting. JOLTS. Released mid-month, about 2 weeks after the reference month ends. Shows hires and quits rate. The quits rate, how many people voluntarily quit their jobs, is a great measure of worker confidence and wage pressure. High quits equals workers know they can find something better, equals wage inflation risk. Employment cost index, released quarterly, end of January, April, July, October. The Fed's pressure measure of total labor cost inflation, including benefits. Less attention from media, more attention from the Fed. Read this before every quarterly FOMC meeting. Mark all 5 in your calendar. ADP Wednesday, NFP Friday, claims every Thursday, JOLTS mid-month, ECY quarterly. These are your labor market calendar anchors, without fail, every month. So let's just end this, because I don't know why, but I can't fucking read today. Conclusion. Sorry about that, I can't freaking read today, I was meant to say. Conclusion. Let's pull together 3 episodes of work. You now understand the Federal Reserve dual mandate. Inflation, keep it at 2%. Employment, keep it at maximum, roughly 4% unemployment. These two forces are always in dialogue. Sometimes they push in the same direction, often they create tension, and that tension, more than almost anything else, drives central bank decisions and therefore currencies. Episode 1, interest rates, the mechanism. Episode 2, inflation, the primary trigger. Episode 3, labor markets, the second trigger and the inflation amplifier. When inflation is hot and the labor market is tight, that's the most hawkish possible environment the Fed has to hike. The dollar surges. This was 2022. When inflation is falling and unemployment is rising, that's the clearest case for cuts. The dollar weakens, and this is what markets were watching for in 2023 and 2024. The interplay between these three forces, rates, inflation, labor markets, is what macro trading is built on. If you understand when these three are aligned versus when they're in conflict, you're already ahead of the majority of retail traders. In episode 4, we're covering GDP, what it is, how it's measured, how it connects to everything we've learned so far, and what a recession actually means for currencies. Because GDP is the scoreboard. It tells you whether all of this, the rate hikes, the tightening, the jobs data, is actually working. So subscribe, and the next episode in macro will be about GDP, but there will be before that a general trading video in the other series. So yeah, see you next time. Bye.